Welcome to the Retiring Canada podcast, where our mission is to educate and empower you to make the most informed, rational, and productive financial decisions. Hosted by certified financial planner, author, and chartered investment manager Michael Isbister, you'll go behind the scenes to uncover the tips and strategies to help you invest smarter, optimize your retirement income, and reduce the amount of tax you pay. Michael is an investment advisor with Fundamental Wealth, a trade name of Harbourfront Wealth Management, an IROC dealer. And now, here's your host, Michael Isbister.
Hello everyone, and welcome to the Retiring Canada podcast. In today's episode, we're going to discuss how to destroy your retirement. Specifically, I'm going to chat about 2 retirement risks you probably don't think about, 10 ways to mitigate these risks, and lastly, as always, a few action items for you to consider. Now, the title to this episode is quite obviously tongue-in-cheek. No one wants to destroy their retirement plans, and I'm in the business of ensuring people don't do just that. But the simple fact is that you only get one shot at retirement. And I think most of you would agree that you really do not want to unretire and go back to work. So today, I want to discuss 2 headwinds that have the potential to destroy your retirement and force you back into the workforce if not thoughtfully planned for. But before that, if you've been enjoying the podcast, please consider leaving us a 5-star review in your favorite podcast app so that our message can reach more Canadian retirees who definitely do not want to destroy their retirement and would prefer to stay happily retired. Now, admittedly, there are more than 2 risks that can derail a retirement. Poor health, inflation, an emotional investment decision driven by fear or greed can also call into question the long-term sustainability of your retirement. Today, I'll be getting a bit more technical and speaking about the 2 key headwinds that could push you off course as you near and enter retirement. And those are sequence of returns and reverse dollar cost averaging. Both of these, if not accounted for, will increase the probability of your retirement plan failing. Let's start off with sequence of returns. In English, sequence of returns is the variability of investment returns you experience in your retirement portfolio. If over a 10-year span, your portfolio returns, say, 6%, the path over those 10 years wasn't a straight line of 6% every year. Rather, there were up years with double-digit returns and down years with negative losses. So, although the end result after 10 years may be an average 6% rate of return, the path to getting there had its ups and downs. This is called sequence of returns. So why does this matter? Well, if you're an accumulator and you aren't touching your nest egg, it makes no difference to you how you end up at that 6% after 10 years, as long as you stayed invested. However, for the retirement investor, you do not have that luxury, as you are actively drawing on your investments to live from. This is why retirement income planning is so incredibly important, as you are exposed to the greatest amount of risk in those first few years of retirement. Think about it. If your retirement investment goes down by 10% in the first year, and you withdraw 5% to live off of, your portfolio is down 15% right out of the gate. Follow that up with another bad year of, say, negative 5%, plus another 5% withdrawal, and in just 2 years, your portfolio has been decimated by 25% decrease in its original value. To bring your account back up to the original amount in year 3 and continue to draw 5% from your portfolio, you would need to earn nearly 40% to get back on track. Crazy stuff. Just 1 or 2 bad years at the beginning of retirement can completely put your retirement at risk. We don't know what will happen in the markets or what sequence of returns you will receive, so it is crucial we make a plan that factors in sequence of returns. It could be the difference between a happy, stress-free retirement versus unretiring altogether. Now, the second headwind is closely related to sequence of returns. However, with this factor, you do have some control over its outcome. This is called reverse dollar cost averaging. In English, periodically pulling money out of your retirement accounts and putting it into your bank account. Now, you have probably heard of dollar cost averaging, which is an investment concept for investors who are adding money to their retirement accounts monthly and averaging their investment purchases into the market, rather than trying to delay or time their investment contributions. With dollar cost averaging, you are purchasing the investment regardless of the price at that time. The opposite is true for reverse dollar cost averaging, where you are selling your investment regardless of the price or what's happening in the markets. This is where developing a proper investment allocation that keeps some money in low-risk investments, a cash reserve to help defer selling investments during down markets, and having a solid budget that has you living within your means become incredibly imperative. Sequence of return risk and reverse dollar cost averaging are completely intertwined and add significant complexity and risk to your ability to retire and stay retired. So by now you might be thinking, okay, Michael, how do I address these risks? Let me share with you 10 key strategies to help address these risks and mitigate their impacts. Number 1, diversification. This one I'm certain you have heard of before. Don't put all your eggs in one basket. In broad terms, it can be thought of how much equity and fixed income you have in your portfolio, and in more refined terms, diversification can mean how much of a certain country you have in your portfolio, a specific industry sector, how long your bond duration is, and more. It can get quite complex. The most common issue we come across when reviewing an investment portfolio is often a concentration of holdings in the Canadian market. Now, don't get me wrong, I live here and I love Canada, but the fact of the matter is that Canada only makes up a little over 3% of the global stock market. So why would you hold more than 50% of your retirement assets here? Now, most portfolios in Canada will have a Canadian bias, which isn't inherently awful. However, when the Canadian portion of your investment starts to surpass, say, 30 or 40% of your money, well, your retirement portfolio is exposed to a lack of diversification. Number 2, living within your means. Retirement is a strange pivot for most people, not only in lifestyle and free time, but also the way they think about money and their investments. Now think about it. You've spent your whole life adding to your investments, and now it's time to start taking money out of those investments to live on. Furthermore, it is common for retirees to spend a little bit more in those first few years. Travel, hobbies, and more time on your hands can no doubt lend itself to increased spending. But as I spoke about already in this episode, those first few years are crucial, especially if you happen to get the short end of the sequence of returns stick, i.e., the first few years of your retirement are turbulent markets. If you do find yourself in a scenario where markets are down in those first few years, you may even want to consider delaying that trip or large purchase, especially if your retirement plan was tight to begin with. Now, there are strategies we put in place that I will talk about next that can help plan for these first few drawdown years so that you can continue to do the things you love regardless of the markets. But the bottom line to get across here is that you cannot out-earn a bad budget. You can't control the markets, inflation, and what politicians say and do, but you can control what you spend. Number 3, make a retirement income plan. Once you have your asset allocation in order and a strong understanding of your spending needs, you'll want to develop a retirement income plan that helps to move the money from your investments to your bank account in a tax-efficient manner. Start with determining your fixed income. So, things like Canadian pension plan, old age security, employer-defined benefit pensions, and fixed annuities. The difference between these fixed pensions and your monthly spending represents the amount of income your investments will need to be able to generate after tax to fund your retirement lifestyle. To take things a step further, you need to have a plan in place when the markets inevitably decrease so you aren't forced to sell your investments while they're down. This is the reverse dollar cost averaging I was speaking to earlier. Having a war chest of high interest savings, GICs, and target date bond funds could be tools you consider holding in your retirement portfolio. That way, when markets inevitably drop, you can pivot where you draw your income from and protect your retirement nest egg. For a bit more information on this process, I suggest you listen to episode 22 of the podcast. Number 4, consider annuities. Depending on your income needs, risk tolerance, overall assets, and health, you may even want to consider adding a fixed annuity to your retirement plan. What is a fixed annuity? Well, in its simplest terms, you have an insurance company and you give them a lump sum and they promise to pay you every month until you or your spouse dies. Now, there are many different variations and options to consider, so I'm oversimplifying things here quite a bit. There are also options called insured annuities, whereby you give the insurance company a lump sum, they pay you monthly till you die, and when you die, a lump sum benefit is paid to your beneficiaries. Now, annuities don't make sense for everyone, but if you find yourself to be a conservative investor that cannot stomach market volatility, this type of solution is something you will want to consider. Number 5, bond or GIC laddering. This concept takes the retirement income plan a bit further. Having a small portion of your holdings in a low volatility or guaranteed solution like a GIC can help you implement a retirement income plan that gives you the ability to defer selling equities when markets are down. The term laddering refers when these GICs or target date bond funds are maturing. So, for example, if you retired in 2024, you may consider a bond or GIC that matures in 2025, 2026, and 2027. As these investment solutions mature, you ladder the next one behind the last. So, when the 2025 GIC investment renews, you roll it into 2028. The purpose of this strategy is to complement the other cash and cash equivalents you have in your retirement portfolio. Now, it's important to note here that a bond or GIC ladder shouldn't be a standalone investment strategy. Rather, it should be built together with a thoughtfully constructed retirement portfolio. Number 6, have an action plan for when the markets drop. Now that you have a few of these strategies ready and waiting, the important part is to actually execute the plan when the time comes. How will you make this decision? When will you make this decision? When your portfolio drops to a certain dollar value, or when the markets decrease by a certain percentage? Or maybe when a news headline strikes fear. Will you draw from your high interest savings first? What are the tax implications? When will you shift your income withdrawals back to your regular investments? All these retirement income plans, bond ladders, and diversification, all these things, they're great. But if you don't have a plan to execute and stick to it, your plans will be laid to waste. Number 7, stay invested. Assuming you have proper asset allocation and a healthy reserve of cash and cash equivalents, staying invested with the balance of your long-term portfolio is crucial. Exiting the market might make you feel, a sense of relief in the short term. But the fact is that you are now taking out your crystal ball and trying to predict when the best time is to buy back into the market. This is called market timing. And I promise you that if the quote-unquote professionals don't get it right, don't take it into your own hands to be a market timer. This is a surefire way to decimate your retirement. Number 8, asset location. where your investments are located across all your retirement accounts is a big deal. This is because we're always thinking about tax and tax efficiency with our clients when we look at their retirement accounts. If you are holding tax inefficient investments, you may need to draw more taxable income out of these accounts to net the same amount in your bank account. This is especially important when your retirement hits a snag due to down markets in the first few years. Having your investments in the right location will help to ensure tax-efficient withdrawals continue as planned, regardless of market cycles. Number 9, consider alternative assets. In episode 24 of the podcast, I discuss alternative assets and how they can play a role in a retiree's portfolio. One attractive aspect of some alternative investments is their smooth return profiles. In other words, less swings up and down. Another added benefit of alternatives is the low correlation to traditional public equities and fixed income. So when the stock market jumps or plummets down, alternatives tend to remain steady. Why does this matter? Well, as a retirement investor, adding a portion of your money to this asset class may help to reduce the impact of substantial drawdowns in public markets, giving your retirement portfolio enhanced resilience from sequence of return risk. It also means that as you draw down your retirement paycheck every month, you are less impacted by periodic swings in the market, in turn reducing the reverse dollar cost averaging risk previously discussed. Number 10, discover our fundamental retirement plan. We specialize in helping retirees. This is our day-to-day. So what seems complex and scary to you is a regular Tuesday afternoon for our team. We are passionate about our retirees and care about their well-being and ability to stay retired. To help ensure a smooth, repeatable process, we have thoughtfully developed the Fundamental Retirement Plan to help mitigate sequence of returns risk and reverse dollar cost averaging. To learn more, please visit fundamentalwealth.ca. Okay, so that'll do it for today, your action item for today's episode. Grab a pen and paper or open a notes app in your phone. Make a note of each of the 10 strategies I discussed and put a check mark beside the strategies you have in place and review and address any other gaps in your current retirement plan. Here they are again. Number 1, diversification. Number 2, living within your means. Number 3, creating a retirement income plan. Number 4, consider annuities. Number 5, learn about GIC or bond ladders. Number 6, have a plan for when markets drop. Number 7, stay invested. Number 8, asset location. Number 9, consider alternative investments. And number 10, discover our fundamental retirement plan. All right, folks, that'll do it for today's episode. Be sure to sign up for my weekly Retiring Canada newsletter. And hey, when it comes to your retirement, don't take chances. Make a plan so you can retire with confidence.
All comments are of a general nature and should not be relied upon as individual advice. The views and opinions expressed in this commentary may not necessarily reflect those of Harbourfront Wealth Management. While every attempt is made to ensure accuracy, facts and figures are not guaranteed. The content is not intended to be a substitute for professional investing or tax advice. Please seek advice from your accountant regarding anything raised in the content of the podcast regarding your individual tax situation. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning.